Well, hello and welcome everyone to Homebuying 101, What YPs Need to Know, sponsored by First State Bank. My name is Amanda Glasson, and I am the YPN Program Manager and Graphic Designer with the South Bend Regional Chamber. I'd like to introduce you to Sean Hendron, Mortgage Loan Originator with First State Bank, as well as Steve Smith, broker and owner of Irish Realty. If you guys have any questions for either of them during the presentation, feel free to put them in the Q&A or the chat, and we'll come back to those at the very end. With that said, thank you both so much for joining us today, and I'll hand it over to you guys.
Awesome. Well, we drew straws and I got the short straw. So I'm Steve Smith of Irish Realty, and I've been an avid YPN fan for many, many years. Unfortunately, I just turned 40 this year, so I'm not a young professional any longer. I guess I'm middle-aged over the hill now here, but super excited to be with you guys today to talk about first-time home ownership, but home ownership in general as well. So feel free to get your questions out there, even if you're not a first-time home buyer. And I'm going to share my screen here real quick. And yeah, each of us are going to kind of go through and try to hit some hot topics for you, give you an overview of some stuff, and then we'll certainly open it up for some Q&A because we want to get in the weeds with you guys and hit some things. So just at kind of a high level here, just let you know that we got an awesome team here at Irish Realty, and I've been in the business for 18 years. We love working with buyers, and it's a great time to buy homes. We're going to talk about what that looks like and how to navigate this market that you hear a lot of chatter in the news about what's going on. Here's just a couple updates on Indiana's housing market. November this year versus November of last year, the December stats aren't yet. We see closed home sales are down 27%. And so this could be good news for you guys as buyers. We're starting to see inventory tick up a little bit now that we're past the holidays. We expect that to continue, having more homes to come to market here, so better options for you guys. And our median sale price in Indiana is $230,000. We'll kind of give you some context, for that, for where you might fall, what can I afford, and those kinds of things. And we'll talk a little bit about the housing process as well. Also, Indiana's housing market's faring a lot better than nationwide. Maybe we shouldn't buy right now because values are going to plummet and crash. I don't think that's likely to happen here much or at all. And so another reason not to stay on the sidelines. This may be one of the best times for you to buy a home for years to come. So we'll talk a little bit about that as well. Just a couple other little stats here to bring it closer to home in St. Joe County. This is 2021 versus 2022. You can again see that both new listings and closed sales are down a little bit, but home values are staying consistent and still rising a little bit. We're seeing a slow of appreciation or inflation, which is good. That means you're more likely to be able to get a house closer to its listing price. And you may have heard of bidding wars, or some of you may have experienced them if you've already been trying to buy a home. It's still very competitive in our market in the $100,000 to $250,000 range, though. We're still seeing a lot of action there, and that would be like a monthly payment kind of between $800 per month and $2,000 per month. So if you find yourself in that bucket, like a lot of people do, it's still fairly competitive out there in our market. But you can see that inventory supply has gone up from 0.9 to 1.4, which is a 50% increase. So that means you're going to have a little bit more options to look at as you enter this process, and also that you might actually get to go back for a second showing or take a breath before you have to pull the trigger and jump in. So first time buyers today, a lot of buyers are looking for green friendly locations, walkable areas. And all of our cities, South Bend, Mishawaka, are doing some really cool things. So there's some great options on the edge of town, but also in the heart of town, both new construction, renovation, existing homes. And so some great opportunities there. And just letting you know a couple things about first-time home buyers. How much do I have to put down to buy a house? Well, the average first-time home buyer is putting down about 6% versus the average person buying, a repeat buyer buying their second or, buying for the third time is putting down 17%. And there's some great lending products out there. You don't have to put 20% down to buy a home. You can put 5% down. You can put 3.5% down. And even in some cases, you can put 0% down if you're a veteran or qualify for USDA loans. So there's some really cool programs out there. And Sean's going to talk about that in our next segment for sure. But also saving for a down payment can sometimes be an impediment for buyers. So those are things we want to talk about for sure. So that's kind of it for my overview content. Just want to talk a little bit about the process of what it looks like. First of all, there's no specific order in which things can happen, but you're definitely going to want to talk to a lender pretty early in the process, unless you have already saved enough money to pay cash for a home, which 92% of buyers have not. It's even higher in first-time buyers. Obviously, you're going to need a loan, and so you're going to want to get to a lender right away and just find out more information about what's possible, and typically get pre-approved. As a realtor, we will often take a client out and see one home. We'll show you one home to get you in a house and get you, building some rapport and a little bit of familiar with the process. But you really do need to meet with the financial institution, make sure you're prepared to buy a home before you go and look at a lot of homes. Certainly, you could go to open houses or other things like that and see homes. Another question people have is, do I need to have a realtor? And the short answer is no, you don't have to have a realtor, but an enormous amount of homes are listed with realtors and purchased through realtors. And as a buyer, generally speaking, the cost of a realtor to you is either low or no cost. So the way the brokerage industry works is that sellers offer a commission, and then a listing agent who's representing the seller offers to cooperate with the buyer's agent. And so in the vast majority of circumstances, you pay your realtor 0% commission. So it is a great idea to avail yourself of a professional who's going to cost you little or nothing in terms of money coming out of your actual pocket to help educate you and navigate through the process. So you don't have to commit to a realtor right out of the gate. You can go to open houses. We'd be happy to show you a home. Other people, the listing agent, might be happy to show you a home. But pretty early on in the process, you're going to want to find somebody that you feel like you can trust, that can help educate you and help you navigate the process. And chances are it's going to be for you. So that's a great opportunity and a misconception that a lot of people have. Just a couple more little points here. I don't want to go too long without kicking it over to Sean, and also, eventually getting some more of your questions in here. How much can I afford in a home, right? Well, if you are currently paying rent or have a monthly payment, couple benchmarks just to throw some numbers out there. Today, interest rates are around 6.875% for what's called a conventional loan. A lot of first-time buyers are putting 5% down. That's the kind of the minimum for most buyers who have good credit and qualify for that. If you're doing PITI, principal, interest, taxes, and insurance, and you're also going to have some mortgage insurance, your all-in payment on a $100,000 home is going to be around just under $900 a month, $880 a month for a $100,000 home, $1,640 for a $200,000 home, $2,400 for a $300,000 home, just to give you some of those benchmarks. And another good rule of thumb, this really helps you kind of move up and down. Oh, well, what's the difference between 130,000 or 150,000? Once you kind of got a benchmark, your payment's going to go up roughly $75 per 10,000 in your purchase price. Great way to kind of move up and down the ladder. If there's a particular home you're interested in and you offer, 140 on it, end up paying 150, well, your payment's going to go up $75. So that's just another benchmark to throw out there for you. And a lot of people spend 20 to 30% of their income on housing. So that's another quick way for you to get in the ballpark on what you might be able to afford. So we got some great options for first-time home buyers. And so if you have any more questions, I'm looking forward to answering those. And certainly after the session too, we're always available to answer those questions. So I'll go ahead and kick it over to you, Sean.
Thanks, Steve. Let me get my presentation here pulled up so we can get going on it. I'm going to dive in pretty quick. I got quite a bit of information for you guys, so just want to dive in because I'm not sure how long I'm going to ramble on in front of you. So, um, as Amanda said at the beginning, I'm a mortgage loan originator at First State Bank. I spend the majority of my time in our South Bend location, right over by the new Trader Joe's on South Bend Avenue. Just a little bit about myself. If you decide that you want to talk with me about possibly getting financing set up, that way you know who you're working with. Outside of work, I enjoy traveling with my wife, and according to her, who she was the one who's put together the slideshow for me, but according to her, the vast majority of my personality revolves around Lego, apparently. I collect and build Legos, collect movies, got quite the collection of movies in my house. So, big sports fan as well. If you come into my office, you'll see some Blackhawks memorabilia. I got a gnome out here. So just a little bit about me. That way, if you want to come and chat, you know a little bit about me before we get into it. So I'm just going to go over the mortgage process with you guys, what it looks like from start to finish. It can be daunting, it can be intimidating. A lot of nerves can be involved. So I'm just going to lay it out for you, go into detail on a lot of the stuff that's going to happen throughout the process. So with that being said, Steve mentioned there's not really a right answer to tell you, okay, you need to start with a realtor or you need to start with a lender. I always say, you got to start by understanding your finances. So you might think that you know how much home you can afford, but without talking to a lender, you're not going to know for sure. So depending on your debt ratios, you may not qualify for certain financing programs that are available out there. I'll talk a little bit more about debt ratios later on in my presentation, but let's get into finding a lender. So how should you find one? Obviously, you've got friends and family out there that are probably homeowners. Ask them for recommendations. Your financial institution probably has a lender that you can talk to as well. Or if you're already in contact with a realtor, they're definitely going to have some lenders that they can recommend to you that they've worked with in the past, worked with regularly, and they trust that they'll get the job done for you. Once you've contacted a lender, the process is truly going to begin. As a first-time home buyer, let the lender know because they're going to tailor the way that they kind of explain things to you a little bit differently as a first-time home buyer than if you were a repeat buyer, second, third time purchaser. So let them know. That way they can tailor what they're talking about to you. So they're going to ask questions from you, probably give you some information that you're looking for. From there, you can decide whether or not you want to do a formal application with that particular lender or not. Once you get to the application part of it, that's where we're going to get into all your specifics. As a lender, we're going to ask for your personal information, your date of birth, social security number, address, stuff like that. We're going to ask you current employment. If you've had less than 2 years with your current employer, we're going to go back and ask you about your past employment. We're going to want to know what kind of assets you have, checking accounts, savings accounts, 401ks, stuff like that. We're also going to ask you about demographic information on most loan applications. We're not allowed to discriminate based on that information, but for a lot of the applications that we take, this information is actually required by the government for monitoring purposes to make sure that we are not discriminating. And the lender may, once they get through that application process with you, ask you what kind of dollar amount you're hoping to get pre-approved for and how much of a down payment you think you're going to be able to afford. From there, that'll give them a good idea of what type of loan financing that they're going to try to get you pre-approved for. Now, obviously, you've probably seen that certain lenders will offer pre-qualifications early in the application process. There is a significant difference between a pre-qualification and a pre-approval. The pre-qualification is simply going to be based on the information that you've provided to the lender without any verification. So when you're discussing your employment and your income, the lender's going to use the figures that you provided through that conversation without any supporting documentation. So they're going to just say, okay, you said you make $25 an hour and you work 40 hours a week. We're going to determine your income just based off of that verbal information that we received. This is going to give you a good ballpark estimate of what you can expect to be able to afford to qualify for a mortgage, but many factors can actually result in this estimate not being accurate. And that's where we get into the actual pre-approval. Pre-approvals take it a step farther, and we take all the information that you've given us in your application, and then we ask of you supporting documentation to prove everything that you've given to us. So we're going to be asking for pay stubs, W-2s. If you're self-employed, we're going to be asking for tax returns. We're going to ask for bank statements, statements that show for any of your assets. So once we get all of that information, we can actually boil it down, get a accurate figure of what income to use and things like that. So each person's situation is obviously a little bit unique. Most people are W-2 employees, so we're going to be asking, like I said, for those W-2s, pay stubs, bank statements. Obviously, depending on your situation, we might need more documentation. So once we get into self-employment, things like that, we're going to need more documents than for just a standard W-2 employee. Lenders are really good, usually really good, I should say, about issuing pre-approvals really quickly, especially when you have a pretty straightforward financial situation. Delays happen, in my experience, delays happen when you as the buyer, as the client, aren't getting me the required documentation quickly. We have to have that documentation in file to issue a pre-approval letter for you. Once we get you a pre-approval letter, they're usually good for 90 days. If you don't find a house within that 90 days, but you still want to look, talk to your lender. They'll obviously let you know what needs to happen to get you a new pre-approval letter. Usually that's going to be updated documentation from you, so new pay stubs and bank statements, things like that. As Steve mentioned, a lot of realtors aren't going to want to show you very many homes without a pre-approval. So with Irish Realty, they're going to show you one, and then they're going to want to make sure that you're pre-approved. This is going to obviously help them make sure that they're not wasting their time and that you are a serious buyer. The other thing is, if you try to go and submit an offer on a home without a pre-approval, the market conditions the last few years, sellers they're not interested. They want to make sure that you have taken the steps to make sure that you can actually close on a mortgage loan, so that they're not wasting their time either. There's really no downsides to getting pre-approved. Like I said, with a pre-approval, you're ready to make an offer on a home that you love when you find it. The biggest part is just taking the time, taking the energy to gather up those documents that you're going to need. Sometimes, for some reason, some people just really want to drag their feet with trying to get those documents to a lender, and you might see a house that you really like and really want to see, but since you're not pre-approved, you're kind of out of luck there. So when we do a pre-approval, lenders are going to determine your eligibility based on a multitude of different factors. But the big ones that I'm going to focus on today with you are going to be credit worthiness, employment, verifiable income, and personal assets. So when we look at credit worthiness, what does that really mean? We're going to look at your credit report for one. Any debts that are reported to the credit bureaus will show there. We're going to look at the types of accounts you have open, your payment history on those accounts. We're really wanting to make sure that you're making on-time payments every month. We're going to look at your balances, the minimum payment amounts, and a multitude of other things on there, but those are going to be the big things on your credit report that we're going to look at. When we look at your employment, we're going to want to look and see what type of employment it is. And if you've been steadily employed for at least 2 years. And if there is a job gap, why do you have the job gap? So we're going to need an explanation. If you've had a job gap for, more than a couple weeks, a month, we're going to need to have some sort of explanation as to why you weren't working for that period of time. And obviously, we're going to look at that job stability. Have you held the same job for a long period of time, or are you a job hopper? If you're a job hopper, that's fine, but are you hopping between jobs that are in the same field, or are you struggling to find what you want to do as a career, and now you're hopping between fields? When we get to that, when you're hopping between fields, we get to the next aspect, which is income. It gets kind of hard to determine what qualifies as stable income for you. When we look at your income, we're going to see how you're paid. Is it salary? Is it hourly? Do you get paid piece rate or some other type of payment schedule? Income history, we're going to want to look and see if you're making at least the same amount of money now as you were last year and the year before. What that shows us, especially if you're in the same job, if you're making the same, if not more money on a year-to-year basis, we're obviously seeing good performance from you, and that employer is comfortable enough giving you pay increases. If you don't have income as of right now that is better or the same as it has been in years past, why not? Is it because you've changed jobs, or are there other underlying factors that need to be discussed? And then, of course, your personal assets. We're going to look for your tangible liquid assets that you can use for a down payment and closing costs and things like that. Checking accounts, savings accounts, 401ks, like I said earlier. We're also going to want to see, we'd like to see that you have a reserve built up, which is basically a backup in case you lose your job or you have to change jobs. That reserve is going to be there to make sure that you can make monthly payments for a couple months at a time. So once we look at all of that, and I'll pause here for a second. When we talk about debt ratios, most lenders are going to have a computer program that they use to do their mortgage applications. So a lot of this is just going to be done by a computer system, but it can be done manually, and it has been done manually in the past before these automated systems existed. But once we've looked at all of your information, now we're going to come up with your debt ratio. And your debt ratio is simply a comparison of how much verifiable income that you have against how much debt that you have. And we're going to include a new house payment in that debt ratio. So what are your debts? Debts are things such as credit card payments, car payments, collections, student loans, personal loans. Anything that shows up on your credit report is a debt if you have a balance and a monthly payment. Some debts aren't going to show up on your credit report, but they may be legally binding that you have to pay. Things that come to mind for that are alimony, child support, stuff like that. There are plenty of things that you probably pay for that we're not going to count against you as debts. Car insurance, your cell phone bill, utility bills, Netflix, cable, internet, those types of bills we're not going to count against you because those things are not necessarily necessities, and a lot of those things can be canceled. Obviously, your utility bills, you don't want to go without heat and water, but those are not calculated in your debt ratio as debts. So just want to go over a quick example with you, just to kind of show you what the debt ratios kind of act like, look like. Let's say as a lender, I've determined that your qualifying income is $4,000 a month. Each financing type, each loan type might have its own qualifying debt ratio, but the most common one, the one that you're probably going to hear the most, is 43%. And that basically means that all of your debts combined with a new house payment can't exceed 43% of your $4,000 a month income. And if we do that math, that breaks down to $1,720 a month for all your debts and a new house payment. So if we say $520 in other debts, credit cards, car payments, all that stuff, that drops us down to $1,200. And let's say homeowners insurance, property taxes on your new house, those are estimated at $200 a month. So now that leaves us with $1,000 for a housing payment. And you guys can go out there. There's plenty of loan calculators that can determine a loan amount. You can download one on your phone. You can go online and just do a Google search. There's plenty out there to just do a quick calculation. You'll just need a couple more pieces of information. You're going to need an interest rate, and you're going to want to know how long you want your loan to be good for. Let's just use an interest rate of 7%, just round it to an even number, and you're going to do a 30-year term on your loan. When that gets calculated, that's roughly about $150,000 on a loan amount. And I'm going to say that you're a rock star and you have 20% saved up for a down payment. With that in mind, you're going to be able to afford a house with a purchase price of about $187,500. So what does the lender do with all this information once we've got it calculated? Once we've verified it, we've come up with that number, we're going to issue a pre-approval letter to you. We're going to tell you that you're pre-approved for a purchase price of $187,500, and we're going to tell you how much down you need. In this instance, we're saying 20%. We're also going to list any other requirements that need to be satisfied before you can actually close on a loan. So for repeat home buyers, maybe they need to sell their current house before we can close on their new home. So that would be listed on the pre-approval letter. And obviously that needs to be satisfied before the lender for the new home would give you a clear to close. One thing to keep in mind, you're talking about interest rates all throughout this process. The lender cannot lock you into your interest rate until you've found a home and you have a signed purchase agreement. So me personally, the 43% debt ratio threshold, I'm going to try to be a little bit below that if I can. That way that gives us a little bit of wiggle room in case the unfortunate thing happens where interest rates may rise. So that gives us a little bit of wiggle room because we may get to the point where you found a house a month down the road, but interest rates have gone up a quarter point. And now with the new interest rate, you're either having to put more down or you simply can't afford the monthly payment. So keep that in mind. And again, the lender will more than likely stress that to you throughout the pre-approval process, that we're not locking you in until you've got a signed purchase agreement. So with that pre-approval letter, you've got 90 days to find your dream house, make an offer, get an accepted offer, and close on your purchase. Of course, going back to what I said earlier, if your pre-approval letter does expire, you can work with your lender to have a new one issued. So once you've gotten your pre-approved, you've looked at your 30 houses. Hopefully you don't look at 30 houses anymore. My wife and I did a couple years ago. That was super fun. But so once you found the house that you want, you submit an offer, it gets accepted. From here, the lender's going to get a purchase agreement, whether it's from you or from one of the realtors involved. At this point, this is really where the lender gets moving quick. They're going to get your interest rate locked in. Hopefully, it's better than what it was when you got pre-approved, if not the same. And we're going to keep our fingers crossed that it didn't go up. From there, once we get you locked into your rate, we're going to put together a pretty big document package. Once we get that ready, we're going to meet with you and have you sign all these initial documents. Obviously, everything can move rather quickly when you're making an offer on a house. You do that pretty quick, it gets accepted, and then you and me as the lender move pretty quickly to get those documents signed, get appraisals ordered, get inspections ordered, and title work ordered. So we've hurried up, we've done all this stuff, and then it just kind of stops. So you're pretty much at the hurry up and wait mark. From here, everything takes time. So going back to appraisals, what's an appraisal and do you need one? Yes, you need an appraisal. This is how us as the lender are going to verify the value of the property and that the property is in good condition. If the value is too low or the condition of the property is too poor, the lender may not wish to extend a loan offer to you at that point in time. An appraisal is also going to protect you as the buyer, as it's going to provide you with a fair market value for the property, which again, hopefully is going to be equal to or greater than the purchase price. In today's market, we've not been seeing very many homes that appraise for less than the purchase price, but it can happen. And there are steps that need to be taken in order to resolve the situation. You may have to look at putting more money down, or if you cannot put more money down, if the appraisal comes in lower than the purchase price, then you may have to back out of the offer. Lenders are not going to lend more than the appraisal or the purchase price, whichever one is lower. So if the appraisal comes in lower than the purchase price, you got to make up the difference somehow. And hopefully you do have funds available to do that. When we talk about inspections, inspections are usually optional and they're up to you as a buyer to request. Sometimes as a lender, we might require certain inspections if something is brought to our attention in the appraisal, for example. But home inspections are definitely recommended as a protection to you as the buyer. That way you know any issues that might be present in the home. You might have a bad water heater or a bad furnace, and if you don't do an inspection and find that out beforehand, you might be buying a house that you're going to have to sink a lot of money into right off the bat. So once we get appraisals ordered and any inspections that you want to get ordered, again, we're just going to sit here and wait. Generally speaking, all this stuff, inspections, appraisals, title work, this can take up to a couple weeks to get back. Once those are all completed, though, we're going to submit the loan file to our underwriting team. So what's an underwriter? The underwriter's job is to review your loan application and all documentation that has been submitted with it and confirm that everything about this particular loan file conforms to every guideline that you can think of. Federal government has a lot of guidelines that are in place that have to be followed. Lenders may have their own guidelines that also have to be followed. The underwriter is going to be the one who makes the final determination of whether you're actually going to be approved for the loan. They might ask you for some additional documentation in order to make their decision, but they're going to review the appraisal, other documents related to the property being purchased, along with all of your documentation. Once the underwriter is satisfied, they're going to issue their final approval. And sometimes, depending on the lender, you might hear them say that they've given you clear to close, which means that now, as a lender, I can give you the good news and say, hey, we can go ahead and schedule closing. and the lender will tell you, okay, this is the first date that we have available to close, and then all the parties involved can get that scheduled. Closings for home purchases usually happen at a title office, where a member of the issuing title company will actually facilitate the signing of the closing documents. So usually both realtors will be there. A lot of times your lender will be there as well. They've got a couple documents that they need to sign too. So it's usually a pretty full house for a home purchase. You've got multiple parties involved. So it can take a bit of time to get everything signed and everybody satisfied. But once you get your final approval, the lender's going to send you what's called an early closing disclosure. This is going to provide you with an estimate of your final closing costs as well as your down payment. And those two numbers put together, we collectively refer to as cash to close. So your down payment and all your closing costs, this cash amount is what you need to bring to closing in order to satisfy the lender and get your loan closed. I guess now would be a good time to kind of take a look at what closing costs are. Obviously, they are separate costs to your down payment. So closing costs typically include any lender fees, appraisal and inspection fees if you don't pay those up front, title fees, recording fees, any other fees that might be associated with financing. Usually there's a credit report fee. Also included in your closing costs, if you're escrowing for your homeowner's insurance and property tax, we're going to collect a prepaid portion of those up front within your closing costs as well. We're going to collect those so that us as the lender can pay your first year's worth of homeowner's insurance on your behalf. And then we're going to collect a cushion to pay your insurance and taxes each year moving forward. If you do your PITI, principal, interest, taxes, and insurance, if you do an all-in payment, the taxes and insurance portion is your escrow account. We're going to collect a monthly amount that goes towards that to actually be able to pay that on your behalf every time it needs to be paid. And obviously, as lenders, we try to estimate these on your loan estimate, which when you sign the initial set of documents after you get your purchase agreement, you'll get a loan estimate in there, which will detail what our estimate is for all of these costs. So once you get your closing scheduled, a few days before closing, we're going to send you another document, and it's going to be the final closing disclosure. So that early one comes out as soon as we give you the final approval, and the final one comes out once you actually have the date scheduled that you're closing, because that's going to give us the exact day and how much of taxes and insurance prepaids that we need to collect. So every figure on that document should be finalized. And it's going to tell you the exact figure for your cash to close. So down payment, closing costs, all in, this is what you got to bring. And you're going to receive instructions on how to actually provide those funds at closing. So we've made it to closing. You're at the day. Hopefully you're excited. Hopefully all the nerves are gone at this point. What do you need to bring with you? Usually instructions for your cash to close, how to provide those funds to the title company. Usually you're going to send a wire for those. Outside of that, you're going to want to bring a photo ID with you because the title agent will want to verify your photo ID. The most important thing to bring with you, though, is a hand and a wrist ready to sign a lot of documents. It's more than what you're going to sign in your initial document set. So make sure that you're ready, get nice and stretched out to sign a whole bunch of stuff because there's a lot to sign and initial. Obviously, once you're done with closing, that's it. You're done with this process. You're going to get possession of your new home and off on your adventure. it can be an adventure. So hopefully, the process of getting there is smooth. Hopefully the lender that you find is good and makes everything smooth and makes you feel at ease. That's what we try to do here at First State. But briefly here, thinking about the future, going into the future after you've bought your house, you're in your house, maybe you're not very happy with where your interest rate is, or you see that interest rates have dropped significantly since you bought your house. There's always an option to refinance your loan. There can be a waiting period, and it's dependent upon a few things. Typically, what type of financing you chose initially. But if you're thinking about refinancing, talk to your lender, and they're going to go over all your options with you. You can refinance to simply get a better rate if that's what you want to do, or you might even be thinking about doing some home improvements, or you want to consolidate some other debts into your home payment. So you can do that as well. So there's plenty of options out there when it comes to refinancing to better suit your needs down the road in the current home that you're in. Really quickly here, and I'm going to try to wrap up nice and quick, just to kind of go over what First State Bank offers. So shameless plug here for First State. We do offer fixed rate and adjustable rate mortgages. Fixed rate, whatever term you're on, that's what your interest rate will be for the full life of the loan. Adjustable rate mortgages, the rate will adjust at certain intervals throughout the life of the loan. We offer loans for investment properties. We can offer a bridge loan product. So if you have a current home with a lot of equity and you want to buy a new home, you can always take a loan out on your current property to buy the new home, and then turn around and sell your current home and pay that loan off. We do offer construction loans. So if you're thinking about doing a new build instead of trying to find an existing property, we do offer a couple different construction loan products. And lastly, of course, we do offer home equities, home equity loans, and home equity lines of credit, which you can use to leverage the equity that you have in your home for different things. A lot of times lenders aren't going to ask you what you're going to use that home equity for, but leverage the equity of your home to do what you will with. So why First State? We've been in business in our communities for over 100 years. I think we opened in 1910. We're a fairly small community bank. We've only got 5 or 6 branches. Obviously, the one here in South Bend is our newest, just opened in July of 21. I had to think back through there because now we're in 23. So last year wouldn't be true. We do all of our underwriting in-house, and we service our loans in-house, which is a really nice thing because you're always going to be dealing with First State on your loan. A lot of places and brokers will sell off your mortgage, and when they do that, now you're making a payment to someone else. If you have questions about your loan, about your payment, you're talking to somebody else that may not have any idea who you are or what it is that you're trying to accomplish. So we pride ourselves on that we keep everything in-house. And a lot of times, especially with underwriting, that makes things go quicker. Our underwriting team is really good, and usually once we get everything that we need, they can get a final approval within a day or two. We've got a pretty small mortgage team, which is good for you because, again, when you call in with questions, you're more than likely going to talk to someone that you've spoken with before. Obviously, we can't avoid turnover, but chances are that you are going to be speaking with someone that has an idea of what's going on for you. So that's all I've got for you. I'll leave this up here for a minute. This is my contact information, but I guess we can open it up for questions if there are any.
Yeah, I think we've got just a couple that were already answered, but a few that had been submitted just ahead of time to touch on. Steve, you had mentioned at the very beginning that one of the hardest things for young professionals is saving for that down payment. And we hear talk of down payment assistance programs and things that can kind of help get you over that finish line. Now, for those programs, is that something that the individuals should do on their own? Do they talk to their financial institution? Is it the state of Indiana or wherever you may be buying your home, or the city? Where should young professionals look? And is this an individual process, or is it a team with the home buying process?
Yeah, great question. You certainly can do a little bit of research on your own. Lenders are going to be your number one resource to get this information. Just to mention a couple that might be out there, there's a program called IHCDA through the state of Indiana Housing Community, Development Assistance, grant, and you can get a partial grant for a down payment, which is awesome if you qualify. That money gets renewed annually, and once it's used up, it can be gone. So it's January. It's a great time to check into that and see if that's available. There are also some other cool programs. For example, USDA loans, rural development loans. If you're wanting to live in an area that qualifies as a rural development, there may be lower down payment requirements or other incentives available, and many lenders may offer some kind of reduced closing costs or other incentives to help first-time home buyers make their first purchase. So lenders are a great place to start, and certainly realtors are going to help point you in the right direction as well.
Wonderful. And then just to mention too, so we brought up closing costs. Is there any rule of thumb when you're kind of just in the initial stages as a percentage to kind of, as we're budgeting to get the down payment and then also knowing that there's those coming in that people should budget for, or is that really situational and just depends?
I'll take that one. It is situational. It's going to be based off of a multitude of different factors. The biggest being your loan amount, your purchase price, what your homeowner's insurance and property tax look like. For a sub $200,000 mortgage, you're probably talking in the ballpark of maybe about $5,000 in closing costs. And there are ways to see if you can get those paid. Some lenders will offer for first-time home buyers credits towards those that'll lower those. Another thing that you can do if you're hopefully working with a realtor, talk to them and see if you can work it into your offer to have the seller pay for a portion of those or all of those. As the market kind of cools down a little bit, I think that will open back up. And Steve, correct me if I'm wrong, but I know when my wife and I bought our house a few years ago, we negotiated that the seller paid the full set of closing costs up to a certain dollar amount.
And is that the realtor who does that then?
Yes. So that's at the time of making an offer, that becomes a stipulation that you put in your offer, your purchase agreement. But you're exactly right. There's two main buckets of money that you need to get to the finish line on the closing: your down payment and your closing costs. And so you're going to need to be prepared to handle both of these. In terms of when that happens in the process too, that's another question that people have. Well, like, hey, do I need all this money like today? Kind of. I mean, you certainly don't want to be like, hey, we're closing in 30 to 35 days, which is a pretty typical time that it takes between an offer and a closing. We're not looking to, I'll save those last two paychecks and we'll be good to go. That's not what that looks like in general. But typically when you make an offer on a home in our market, 1% is what's called earnest money. So if you were buying a $200,000 house, often you'd put $2,000 down at the time of making an offer as good faith money. That earnest money will be part of your down payment. So you've now put some of your money in the game, but you'll have to come up with that within 48 hours typically of having an accepted offer on property. So you got to have that for sure right away and on hand. And then most lenders are going to take roughly $500-600 as an application fee, or basically you're prepaying for the appraisal in the event that you don't carry forward with the loan. That's a third-party expense they don't want to be out of pocket on. And so the two things you'll kind of outlay pretty early in the process is that 1% earnest money and that appraisal or application fee upfront. Again, those will be credited towards your down payment and closing costs, but then the rest of the funds are due on the day of closing. And yes, it's a great way to ask for seller paid closing costs. A lot of times, another way to think about that is that you're kind of inflating the price and financing your closing costs into your loan. So if you were to buy a $100,000 house and you wanted to not have to come up with that $5,000 of closing costs in addition to your down payment, you could say, hey, let me raise the price from 100,000 to 105 and give me that back. And so the seller is not going to view that as a major challenge or problem, but it allows you to kind of finance the majority of those closing costs into your mortgage, and it lowers your cash requirements at closing. And you can also receive a gift in many loan product types. An immediate family member, parent, aunt, uncle, sibling could gift you some or all of your down payment. And of course, you want to talk to a lender about that, because there's definitely times where that is allowed, times where it's not. And there's a documentation process that's more involved there. But yeah, you could roll your closing costs into your mortgage, and you could receive a gift of some or all of your down payment, and you might be ready to go today.
Beautiful. Well,
speaking of gifts, I'm going to chime in on that real quick, just to add something here. A lot of time, not a lot of times, but occasionally I will get potential borrowers who come in or are asking about down payments and closing costs, and they might say that they've got $10,000 in cash tucked away in under their mattress. Well, if we need that, we have to have a way to document it. And documenting cash is pretty much impossible to do. So you have to think through things. You have to think in advance. Well, can I give this to my mom and dad and have them gift it to me? Well, yes and no. We're going to need to document where that cash came from for them. So if we see a $10,000 cash deposit on their bank statement, we're going to say, well, where did this come from? And why are you now getting $10,000? So keep that in mind, that especially with gifts, anything cash related, we have to document it. So if you got a big pile of cash laying around that you're planning on using, I would get it deposited, whether you deposit to your own account, give it to a family member to have them give it to you as a gift. I would do that months ahead of time. That way, when we're looking and reviewing your bank statements, we're not going to see that because it's going to be too old.
Okay. No, great information. Anything else that you guys wanted to throw out there? I don't see any additional questions at this time. So any final tidbits of information? Okay.
Yeah, I'll just say that, thanks for joining us today. Hopefully you guys got some good information out of it. I know I rambled on quite a bit, but I really wanted to go into detail on what this whole process looks like for you as a first-time home buyer. That can be daunting. It can be very intimidating to go into this process and have absolutely no idea what you're getting yourself into. So hopefully you take away some good information. And obviously, if you have questions, you want to chat, myself and Steve, we're both available to answer any questions for you and hopefully help you make your dream of owning a home a reality.
Well, thank you guys again. That was some great content you shared. And before we do head out, I just want to thank First State Bank again for sponsoring this presentation, as well as our YPN program sponsors, Gibson and Martin Supermarkets. We appreciate your continued support of YPN South Bend and our mission to develop, connect, and empower the YPs of our region. If you're looking to connect any further, check out our events calendar at ypnsouthbend.com. We've got some great programming coming up in the next couple of months. Our next event is our kickoff power luncheon on January 26th. We hope to see you all there. Thank you guys again and have a great rest of your day then.